Alright, my name is David, and today I'm going to be talking about NVR Inc. NVR Inc. is a parent company that owns Ryan Homes, NV Homes, Fox Ridge Homes, and Heartland Homes. NVR Inc., as you can see here, operates in two segments. They operate in the home building segment and the mortgage banking segment. The home building segment is their main segment. They get over about 90% of their revenue from here, so for the most part, today I'm going to be talking about the home building segment. Alright, so the home building industry is considered to be a mature industry, and NVR Inc. has about 5.7% market share in this industry due to the 4 subsidiaries that it owns. Through these subsidiaries, it builds single-family detached homes, townhomes, and condominium buildings. NVR's main strategy is to be the market leader in all the markets they operate in. Instead of going nationwide and trying to cover as many markets as possible like some other competitors do, they decided to focus on a smaller part of the country and be the market leaders in those markets. Personally, I like this strategy because instead of trying to spread themselves out as much as they can to reach as many markets as possible, they pick the few markets to operate in and then the market leaders in them. This helps limit the competition influence on them, because if they're the market leader, they have the most shares in these specific markets and can make the most profits in those markets instead of taking a lot smaller profits in other wider markets. Some of the risk factors affecting NVR are the fluctuation in interest rates. The fluctuation in interest rates affects the cost of the loans that NVR takes out to finance the construction of these homes. The fluctuation of interest rates also affects the rates that home buyers have when they're trying to finance their homes. The higher the interest rates, the more home buyers will be put off to wait a little longer until these interest rates come down, and this will affect the sales for NVR. Availability of adequate land is another risk factor affecting NVR. When NVR looks for land, they look for desirable location and favorable terms. If they have trouble finding land that has these two requirements, then they have less inventory to build on and less homes to sell. This will affect their revenue for the year. Changes in customer preference is another risk factor for NVR. Since it takes a long time for homes to be built, preferences in homes can be changed. If the style of home that NVR starts building in 1 year, and by the time it's finished, that kind of style isn't popular anymore, this will affect their revenues. Changes in national and local economies is a big risk factor for NVR. The national economy will also affect these local economies, so that's a big one itself. But the small local economies will have a big effect on NVR because, unlike some of their competitors, as I said earlier, they're spread out over all of the US. Because they decided to focus on local economies, if one of these economies tanks, this will have a big effect on NVR's revenue and net income for the year. NVR has a large threat of competitors. Although they have the 3rd highest market share, there are so many other competitors. As you can see in this little snapshot to the left, there's 298,000 other businesses in the home building industry that can compete with NVR. And a lot of these other businesses are in local markets, which is where NVR likes to focus itself. The more small businesses that flood these local markets, the harder it's going to be for NVR to remain a market leader. And considering that's their business strategy, that's a real threat to their net profits. Some of NVR's key accounting policies are that it records its inventory at the lower of cost or market. And NVR's inventory mainly consists of land, the land that it's going to build its homes on. Another accounting policy is it checks for impairment on land a lot. It checks for impairment at the end of every year. It also checks for impairment when it sells these homes. Another interesting thing about NVR's accounting policies is it has multiple allowances for loss. It has allowances for contract land deposits, and this is when NVR entered into a contract to buy this piece of land, but then they had to put a deposit down. But then they decided it's not worth it anymore to purchase this land and build on it, so then they back out of the contract, so they lose their deposit. So they have an allowance for these losses Another allowance account they have is for the mortgage loan losses. Mortgage banking is such a small part of their business, I'm not going to go too much into this. But an interesting thing I'd like to point out is that NVR doesn't have any research and development. There's not too much new technology coming out for the home building industry. So now that we kind of have a background of NVR and the home building industry, we're going to start comparing NVR to its competitors in the industry as a whole to kind of see how it's doing. And in this graph here, I have the revenue growth rate for the industry over the last 13 years, but I only compared it to NVR's growth rate for the last 4 years. As you can see, NVR's growth rate is a lot higher in general compared to the industry growth rate, but it still kind of follows the same trend as up, down, then up again. So this will be interesting when we come back to this in the forecasting. And this next analysis, we're using ratios to compare NVR to DRH Horton and the Pulte Group. These are two of NVR's biggest competitors. As you can see, the revenue growth for NVR is a lot lower than DR Horton and the industry, but it's way above the Pulte Group. So it's kind of in the middle of its competitors right now. Its return on equity at 32.4% is a lot higher than the industry, DRH Horton, and the Pulte Group. It's almost double the industry and more than double the other two competitors. So this is an interesting ratio to kind of compare. The gross margin for all four of these are about the same. Doesn't really set anyone apart. The current ratio, though, however, which is current assets over current liabilities for NVR, is a lot higher than the industry and DR Horton and Pulte Group. So it just means NVR has a lot more current assets and liabilities. So they're not taking on too much long-term debt. Their liabilities are current. All their assets are current. So they don't have too much long-lived assets. And this is kind of interesting considering they're one of the biggest in the market, and they are all pretty current. Price to earnings, it's a little higher than the others, but not huge differences like we saw with return on equity or the current ratio. Alright, so now we're kind of getting into the forecasting of where NVR is going to go. Some of the assumptions I made when forecasting was the sales growth. In the 10K, they said they were pretty reliant on like the growth of the U.S. economy, which I have here on the left, the U.S. GDP for the last 4 years. But as I saw in an earlier graph, NVR's growth rate was a lot higher. So all I get from this is that when the U.S. economy grows, NVR tends to grow, but they aren't too correlated there. So what I did was, since NVR has posted their first quarter sales for 2016, I compared that growth rate to like the first quarter sales to previous first quarter sales and the growth rate there, and then how that growth rate is compared to their overall growth rate. And it turned out that the first quarter sales was pretty accurate as an overall growth rate for the year. So what I did was, to be on a little bit of a conservative side, I took the growth rate for this year's first quarter sales and took about 1% off, and that growth rate comes out to be about 17.5%. And then I used that to forecast what this next year's sales were going to be, and then I have that decreasing until 2022, which is about 7 years, to the terminal growth rate of 3% for the industry. And I picked 7 years because although the home building industry is a mature industry, because of the recession, I kind of see it as growing again, because it got hit so hard in the recession, the industry got a lot smaller. So now I see them as growing again. So instead of having like a 5-year discount to the terminal rate, I spread it out to 7. Another assumption I made was, I didn't put it up here, but for the cost of goods sold, it was pretty consistently about 80% of sales. So that's what I used just straight across the board for my forecasting, was 80%. So now we have the ending operating cash over sales. Right now, or for this last year, it's lower than like the historical data suggests it should be. So instead of making it higher and then going lower as the years go on, I have it slightly increasing every year to kind of get it back to the historical average of between 20 and 30%, because right now it's at 8%. So I have it increasing about 1.5% every year in my forecast to try to get it back to where they have been in the past more consistently. The interest expense over average debt rose to 4.2% and stayed constant for those last 3 years. So I have that staying constant again until 2022 though, not the 2026 when my forecast ends. And this is because it took on some long-term debt in 2012, which is when it rises to 4.2%. And this debt, is due in 2022. I feel like after that, the interest expense is going to go down over the average debt. The long-term debt over assets, I have slowly decreasing until the debt is paid off in 2022. As I mentioned before, they took on some debt in 2012, some long-term debt in 2012. This debt is due in 2022, but I expect their assets to increase. So the long-term debt over assets, I expect to slowly decrease as the assets increase and the debt stays the same. Because I don't expect them to take on really any more long-term debt. Because as I showed in a previous slide, they tend to keep all their liabilities and assets pretty current. So I see them taking more current liabilities rather than long-term debt. To compare this to like analysts predict a steady growth for the home building industry. On the high end, it's 30% this next year, but most analysts come in more about 12%, which this is a little under the growth rate I have for my sales, which was 17.5%. So I'm a little above most analysts, but this is partly because, as I showed in an earlier graph, NVR's sales growth was a lot higher than the industry, and this is the analyst prediction for the industry. So like a 5% difference between NVR and the industry isn't that big to me compared to earlier differences. So based off all my forecasting assumptions that I talked about in the previous slide, I used the discounted cash flow model to find my valuation. And in this model, I use a cost of equity. My cost of equity capital is 9%, and this is based off the industry average. I did try using the CAPM method, but it didn't reflect NVR very well. NVR's current stock price is $1,682.43 per share, and my valuation came out to be $1,762.78 per share, and this is pretty close. Most analysts have NVR stock between like 1650 and like 1830, so like I'm right in the middle of that. I have NVR being a little undervalued in the market right now, but I expect them to grow more than analysts do, so this is kind of why my valuation is higher. And on this next graph, I have sensitivity analysis. So you can kind of see like if I brought my cost of capital down, my value of the company goes up, or if my cost of capital goes up, my company goes down, kind of with the sales growth too. If my sales growth goes back down to 16%, kind of more closer to analyst expectations, then my valuation also goes down, getting closer to where the analysts are right now too. And that concludes my analysis of NVR. Thanks for watching. It's my first time editing a video, so sorry about some of the bad transitions. But if you have any questions, feel free to leave a comment. And thanks.